Hello, everybody. In this session, we are talking about accounting concepts. Accounting concepts are the fundamental ideas, assumptions, and conditions that underpin the accounting process. They provide a framework for recording, reporting, and interpreting financial transactions and information. Accounting concepts are important because they ensure that financial statements are prepared in a consistent and uniform manner, which makes them more reliable and useful for decision making. Both businesses and their stakeholders need these concepts to track their financial performance, make informed business decisions, and comply with financial reporting requirements. Stakeholders such as investors, creditors, and government agencies use accounting concepts to assess the financial health of businesses and to make informed investments and lending decisions. Obviously, if each business organization conveys its information in its own way, we will have a babel of unusable financial data. Personal systems of accounting may have worked in the days when most companies were owned by sole proprietors or partners, but they do not anymore in this era of joint stock companies. These companies have thousands of stakeholders who have invested millions, and they need a uniform, standardized system of accounting by which companies can be compared on the basis of their performance and value. Therefore, accounting principles are accepted as such if they are objective, usable in practical situations, reliable, feasible, comprehensible to those with a basic knowledge of finance. Accounting principles involve both accounting concepts and accounting conventions. And then the types of accounting. The first types of accounting is financial accounting. The systematic process used to generate the financial results of a business organization. The result of all the financial transactions of an entity is summarized and recorded in terms of the balance sheet, statement of profit and loss, and statement of cash flows. The second type's cost accounting. For every business, it is of great importance to determine the costs relating to product manufactured, and cost accounting helps the businesses to make cost decisions. The results produced can be used to determine what a product should cost. The third type's forensic accounting. This accounting is an important branch of accounting that collects, recovers, and restores the financial information as a part of the investigation process. In order to widen its scope, a proper framework defining a set of benchmark for forensic accounting is in motion. And then the basic accounting principles. There are certain basic principles of accounting that are to be kept in mind while preparing financial statements. The first basic accounting principles is historical cost principle. This principle needs the companies to keep a track of the goods purchased, services rendered, or capital assets acquired at the price expended for them. Assets are then recorded on the balance sheet at their historical costs without adjusting them for the changes in the market value of these assets. The second, consistency principle. This principle mentions that all accounting principles and traditions should be functional steadily from one period to the other. This guarantees that financial statements can be compared between different stages and during the past of the company. The third, revenue recognition principle. This principle needs the companies to record their income or revenue as and when it is earned instead of when it is received. This accrual basis of accounting provides a more precise presentation of financial events that occurred during the accounting period. Fourth, objectivity principle. Under this principle, the financial statements, records of accounts, and financial information as a total should be not dependent and free from biases. The financial statements are intended to show the financial position of the company and not to influence the end users to take appropriate actions. Fifth, matching principle. This principle mentions that all the expenses must be matched and recorded with their particular revenues at the time that they were experienced instead of when they are spent. This principle coordinates with the principle of revenue recognition, confirming that all incomes and expenses are recorded on an accrual basis. And six, conservatism principle. It is the principle that shows the general idea of identifying expenses and liabilities as soon as possible when there is doubt about the result, but to only identify revenues and assets when they are confident of being received. I think it is enough for this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe and share. Thank you.